Hello there, everyone. Happy to be here tonight. Can you do me a quick favor before we get started here? And can you just let me know that you can see and hear me okay? Can you put something in the chat? Say yes if you can hear and see me okay. That would be great. All right. Thank you, Samantha. Thank you, Lane. Wow, I was going to let it go for a few more minutes because we had quite a few more people signed up here, but looks like we got a small crowd tonight. But that's okay. You guys will have a little bit more of an intimate, I guess, webinar with myself. But doesn't look like anybody's coming in right now, so I'm going to go ahead and get started. And I guess I'll just keep an eye on it, see if anybody comes in late. But my name's Matt Dean. I'm with Nexa Mortgage, also known as the Mortgage Mentor. But tonight we're going to talk about non-QM loans, and I'm going to show you how to buy a home or investment property, even if you've been told no. We're going to discover how thousands of smart buyers qualifying without W-2s, pay stubs, or even jobs in some cases, or traditional income. So the promise I have for you tonight is in the next 30 minutes, I'm going to show you how to qualify for a mortgage using flexible options that most banks and lenders don't talk about, even if you're self-employed, an investor, or recently had credit issues. Why this matters. Over 40% of the people out there don't qualify for traditional loans, not because they can't afford it, but because the system wasn't really built for them. So the whole non-QM space is giving a lot of those folks out there that don't fit in kind of the traditional box some options. And that's what we're going to talk specifically about here today. Who is this for? These loans are really specifically built for self-employed borrowers, real estate investors, anyone with recent credit issues that may fall outside of the conventional loan guidelines, and anyone with cash and good credit, but no employment or job. So lots of options for some different types of scenarios like that. So what is a non-QM loan? If you have any idea what that means, then you might have talked to somebody about it. But to answer the question, what is a non-QM loan, we really need to go back and start of what is a QM loan and how did it all start? So back in 2007, we had a real estate crash. After that crash, the government put in place the CFPB, which is the Consumer Finance Protection Bureau. They were put in place to regulate the mortgage industry, provide oversight, and really try and protect consumers from high-risk loans. And out of that whole guidance, we got TRID, which is the TILA RESPA Integrated Disclosure Guideline, which got rid of the good faith estimate that we used to use in the past and introduced the new closing disclosure that we use today. Out of all of that, there was an ability to repay guideline, which established QM guidelines. So in a nutshell, what a QM loan is, it's a loan that meets Fannie Mae guidelines and falls within all of those TRID guidelines. So anything that falls outside of a loan that can be sold to Fannie Mae or Freddie Mac has been deemed now a non-QM loan. So what's a non-QM loan? In essence, in a nutshell, it's a loan that doesn't meet Fannie or Freddie guidelines. It is a loan used to help borrowers that can't meet traditional income qualification guidelines. It's used for properties that fall outside of Fannie Mae guidelines, like 5+ units, non-warrantable condos, and unique properties like mixed-use properties. There's also credit guidelines that are a little bit more flexible for bankruptcies and foreclosures that are much shorter to get back into a home or a loan than the traditional conventional loans or even FHA loans. And these are also, these programs also kind of help the foreign national, or there's a lot of foreign national programs built into these non-QM loan. So those that have recently moved here from another country, have limited credit, limited work history, there's also lots of options for those type of buyers. The non-QM space is the fastest growing market segment. It's supposed to, it's taking over about 30% of the overall market, I believe. And really why it's growing is it's filling a niche for those self-employed borrowers or those investors that have a lot of properties that just are having trouble, qualifying for those traditional loans. The other reason that it's really gotten a lot of traction is that in 2023, Fannie Mae completely overhauled their risk adjustments, or what's called loan level pricing adjustments. And really what that means in layman's terms is that Fannie Mae increased the margins on their products, and the products that got hit significantly were non-owner occupied investment properties and second homes. So when they did that, what they did was they increased the rates across the boards on those properties, which made the non-QM rates very competitive because they're almost the same in a lot of circumstances, especially if you've got good credit. So if you have really good credit, the rate difference is not very significant. There are some differences in the overall product, but from a rate perspective, you can get really good terms. In 2025, it's estimated now that we're going to have over $100 billion in funded non-QM loans. So the growth trajectory the last few years has been pretty significant. It got shut down a little bit around COVID, and ever since after everything opened back up after COVID, it's just continued to grow pretty rapidly over the last couple of years. So the type of non-QM loans that we're going to discuss tonight are bank statement loans. Bank statement is probably the most popular one, or the largest utilized product. Debt service coverage ratio loan, DSCR. It's for investment properties where we're looking solely at rent income on a property to qualify. We have no doc loans where we have no employment, no income, no pay stubs, no ratios. We have asset utilization products, CPA prepared P&L statements, and a foreign national program that I mentioned. Those are the main type of non-QM loans that you're gonna see out there. We're going to discuss a little bit about all of them in a little bit of detail here. So I just want to start with a couple of success stories that kind of show how these products are utilized to help some real clients of mine. This first client named Kyle is a long-term client of mine. He's always got a complex situation because he's self-employed, owns multiple properties, has a very creative CPA, can't usually qualify for anything full doc, so it's got to be outside the box. But he had this property down on the Comal River, which is a VRBO property, short-term rental property. And the other challenge that this particular property had is it's a single-family house from a zoning perspective that was turned into a duplex. So it's 2 units. The zoning doesn't match. It's something that would cause conventional financing a lot of trouble. We also had a partner involved with this on the LLC that didn't have good credit, so we had to work around a partner situation. And he had owned this property for a couple of years, bought it through a hard money loan, and needed to get out of that loan. And the company that he initially went with thought they could take it to one of their non-QM lenders. They couldn't get it done for a couple of reasons. One, because of the property type, the zoning was an issue for them. And also they wanted to work off of solely the short-term rental income that he had on his tax returns. Well, we took this to a lender that allowed us to use short-term rental projections. So we didn't have to look at his tax returns at all, and the actual income didn't matter. The short-term rental projected numbers that we got from our software that this lender let us use qualified. We got the deal done, gave us a raving review saying, when most couldn't figure it out, I figured it out. So unique properties like that are specifically what we're, able to kind of help in these scenarios. Hang on, I got somebody trying to get in. All right. Move on. All right, number 2. Just closed this one earlier this year. This was a contractor that does a lot of flips. Guy owned about 15 properties, bought a property here that he rehabbed, and then he moved into it, but he had a hard money loan on it and a note coming due when he came to me in December. And so we had to move pretty quickly. The challenges were he had lower credit scores than we'd really like to see. And he also had a couple late payments on a couple of these mortgages with a hard money lender that he had multiple loans with. And he had a storage situation where he had tried to make the payments at the deadline, and the lender's software was down, and he had emails and communication with them, and the lender itself was not cooperating, and basically hit him with a $4,500 late fee on this portfolio of properties. And at the end of the day, they just wanted their money. And so they weren't willing to change their rating and reported it as a late. So the problem is I had two separate loans there. So it wasn't one late. One late payment on a mortgage is usually pretty easy to get around. When you have two in 12 months, that's a challenge. So we had to jump through some hoops to get that done. We had to restructure those loans, and we had to jump a lot of different things. But at the end of the day, again, we were able to get it done. Very creative. The other thing with this is that we had to use personal bank statements because he changed his business to a personal. He got mad at his business bank, opened up a new account, which they opened it up as personal. A lot of lenders don't want to deal with personal accounts. We had to switch in between. A lot of lenders don't want to use two bank statements. So we just had a lot of moving parts here, but we were able to get this one done for this guy. And at the end of the day, he was very happy. Number three, another bank statement deal, another self-employed borrower. Challenge here was we had a partner that was on the business that was not really in the business anymore. And the income that we were able to use from the business was being cut in half because of this partner. And so part of that was the issue. The other thing is that he had put this property or bought this property with a hard money loan, private loan, and moved the property to a piece of land that he owned. And he had a note coming due on that as well. So we had a hard money loan coming due. We had a short time frame, and we had to figure out how to get this thing done with the partnership situation. So basically, I walked him through it, and we figured out a way to essentially get the partner out of the equation. Got it done, got him paid off on time, got the hard money lender to give us a couple extra days at the end, and we're ready to go to make it work for him. So again, just some scenarios where these hard money loans or non-QM loans have some flexibility that we'd never be able to get done on a conventional basis. So why listen to me? A little bit about me. I'm in the business 20 years, specialize in helping clients overcoming financing obstacles to turn that no into a yes. I funded over $250 million in loans, and I've assisted hundreds of clients needing outside the box financing. And I'm still active in the business. I'm not just one that talks about it. I still do loans every day. So I'm offering, real solutions for problems. All right, hang on. We got one more trying to get in. We got some latecomers, but welcome. All right. Welcome for those that just came. I've also authored a book, Mortgage Made Simple, Your Guide to Home Ownership. If you'd like a copy of it, I'd love for you to join my Homebuyer Academy group. This is a private real estate or mortgage home buying group. Just click on that. It'll ask for your email. Tell me you want your book, a copy of the book. I'll be more than happy to share it with you. If you're that group is more for primary residence, first time home buyer type of stuff, but we do talk about investment stuff too. But if you're more into the investment stuff, I've got another page called Strategic Property Investment Lending. It's not a group, so you don't have to join, but if you just follow it, if you want to comment there and say, hey, I'd love a copy of your book, I'm more than happy to send it to you as well. So would love for you to jump on so we can stay in touch. I can share more information online via Facebook if you're a Facebooker. And did I give you enough time? Do I need to go back? Anybody would need more time there in the chat? All right. Is anybody trying to use the link? Is it working? If not, you can DM me later. I do see that, Samantha. I will follow up with you afterwards if you're not able to log in or use the QR code for some reason. All right, let's move along. 3 big secrets. Let me show you the 3 big secrets that make homeownership and investing possible for people who have fallen outside of the traditional mortgage system. Number 1, you can qualify without tax returns or W-2s. You can even qualify without a job in some cases. But let's talk specifically about the bank statement loan. What are we doing? How are we utilizing this product, and how does it work? So on a bank statement loan, we are looking at the banks are determining the ability to repay based on a 12 or 24 month bank statement. It can be either personal or business. Some banks prefer businesses. Others will utilize either one. A lot of them have a problem kind of commingling the two. But I have done it. But anyway, if we do personal bank statements, we're using 100% of those bank deposits, as long as we can determine that those deposits into the personal account are coming directly from the business. When we use a business account, we are looking at applying an expense factor, and the standard expense factor on most of the programs is a 50% expense factor. Now, if you have a CPA that you work with that will prepare a CPA letter and or a P&L that tells us your expense factor is less than that, then we can use a lower amount. There are some banks that kind of have a scaled system where, depending on the industry that the business is in, that they may apply a different expense factor, but a lot of them just default to that 50%. Again, we can use business or personal. CPA letters help. 100% of those deposits. Credit scores, we can go down to 600, but I'm going to tell you, most of the banks really prefer higher credit scores, 680, 700, 720. The rates are going to be significantly better in the higher credit scores. When you get down into these lower credit scores and the 600, 620, 640s, there are ways to get them done, or there are options, but the loan values are a lot lower. So you've got to have a significant down payment or a significant equity position in order to get something done in that range. CPA prepared P&L programs. These are a couple different ways, or ones that are out there. P&L only. If we have a CPA prepared P&L only, there are some options that will look solely at that. A lot of them that advertise the P&L only program will ask for 3 to 6 months on the business bank account in addition to the P&L, because they really want to kind of see if the income matches up. Again, these products are require higher credit scores typically. I think 700 is the lowest I have for a P&L program. Most of them, a lot of them want 720, 740s. These products are good, in my opinion, for people that have multiple businesses that in some cases have commingled money coming in, where it's just difficult to kind of determine the income from a single bank statement. And we've got maybe a lot of moving parts. If we can get a CPA involved to kind of give us some clarity, it helps out a lot. Investor options with DSCR. Again, DSCR stands for debt service coverage ratio. This is the most popular product on the investor side. I mean, we do utilize some of the bank products for investor too, but in a lot of cases, we're going to a DSCR. What that means is we're looking 100% at the rent income on the subject property to qualify. So if my total payment, principal, interest, taxes, insurance, HOA is $2,000, I'm wanting $2,000 a month rent, market rent, or short-term rent, whatever it is, to cover that at a minimum. Our best pricing is going to be at 125%. If you fall down below, and we can go down below even 0.75, but when you get down into that range where the rent's just not covering it at all, then we have to utilize what's called a no ratio loan. A no ratio loan is possible where they just, okay, there's no more ratio, but you're then going to be looking at lower LTVs. So with 100% coverage, we're typically looking at an 80% LTV. You may see stuff out there for 85% LTV on DSCRs. It's false advertising, in my opinion. 99% of the properties will not debt service at 85%, so it's more of a marketing thing. It typically takes 80%, especially in Texas with the property taxes. But 80% with 100 or better. Some of them might go a little bit lower than 100%, still at 80 on the coverage. But again, best pricing is going to be 120, 125. If we get down less than 75%, then you're forced into most likely doing no ratio, which requires more down payment. And again, the higher the credit scores, the better. Most lenders want 680 minimums. Some of them, get better, but as you get higher in the scores, the better those rates are. They're almost as good as conventional loans. Asset-based loans, the main thing here that's different is we can do asset-based loans on conventional Fannie Freddie. And all that means is that we're taking an asset, whether that be stocks or cash, or investments that aren't necessarily, if the retirement investments and you're of age, that's one thing. But if they're, you're not of age, then there's penalties. But if you have significant assets, mainly stocks or liquid assets, then you can turn that into an income stream by using, with Fannie and Freddie, it's either, 360 months or 240 months. The big difference here with non-QM is we can take that same asset amount and we can divide it by anywhere from 60, 72, or 84 months. So it gives us a lot more income to work with on the same amount of assets. So in some cases, we may not be able to utilize conventional program with that longer factor, and we can get it done on a non-QM. We've also got loans for fix and flip properties and ground up construction. These are more on the private money side. A lot of the fix and flip stuff is that I work with is on local private money. Probably 3 or 4 companies that I work with locally in Austin. There's a couple that we work with nationally. Ground up construction for investment properties is available as well. I'll just say that if you are a flipper, or if you're interested in that, we do have some programs for first time flippers as well. Those are a little bit harder and a little bit, the guidelines are a little bit tougher as far as the loan to values and what they're looking for. But once you establish a relationship and you can prove that you know what you're doing in that market, then we can get a little bit more aggressive on the terms. Right now, the market's a little tough for the flippers since it's cooled off, and so they're having some problems running, getting rid of those properties, unlike they were a few months ago when they could get in and out of them in 90 to 120 days. Now it's taking a little bit longer, and it's causing a little bit of issues, and now values have come down. I've also got loans for commercial properties, both on a stabilized bank type of product as well as hard money. If it's, these products on the hard money side are really for properties that need rehab or stabilization. So if you've got apartments that have vacancies because they need to be rehabbed, same thing with, retail, storage facilities are good, but if there's vacancy issues, they won't qualify for bank loans. If they need to be rehabbed, if they need upgrades, anything like that, we've got money to come in, rehab, and stabilize the properties. There's also bank terms for those that want to refinance something. If you've got an apartment building that's completely occupied and got good cash flow on it, we can help refi those as well, or purchase them. But a lot of people are needing to refi now in the commercial world because they have a lot of notes coming due. All right. So one of the big common misconceptions is that I need a paycheck in order to qualify. And the answer is, no, you don't. And we just talked about it a little bit, but no, you do not need a pay stub. You don't even need a job in some cases. We've got no doc loans, but again, on an investment property, there's no income, there's no employment verification. And the only thing we're looking at, again, on the investment DSCR is the property itself. So if you own other properties, we're not looking at whether there's income or losses on those other properties. We're not looking at car loans. We're not looking at boat loans. I'm not looking at credit card debt. It's just solely the rent income on the property you're buying or refinancing. On the primary residence side, you don't have a paycheck stub. You don't have a job. We have no doc options. So literally no income, no employment, no ratio. We can get you in a home. What are we looking at? I'm looking at credit and assets. So you got to have good credit and you got to have money, but we can get you into a loan if you've got typically 25% down. There are some 20s, but you need additional reserves. So at the end of the day, sometimes the 25 is better. You're getting better rates, and then you have a lower reserve factor. So sometimes it just works out better. But we do have both options. All right, another example. I had a client. This was last year. Some clients of mine, they own a property management consulting group, wanted to buy a property both to utilize as a short-term rental, but they also wanted to use it for their corporate events. And so they would have property management companies come in, they would consult with these owners of property management companies, and they're really like trying to help them improve their revenues. They were working with another lender, and her whole goal was, I want to put it in my company. I want to have events there. I don't want any liability. I want to be able to write it off. I want the liability protection. And she was told for some reason by some other lender that she couldn't put it in an LLC, that they didn't exist, and the rates were awful, and she just didn't believe it. And so the realtor, I guess she was talking to somebody on her own because it was a realtor that I know. He referred her over to me, and we had a conversation. And I said, absolutely, you can put it in an LLC. So we got her in the property. We got them in the property. Again, this was a short-term rental. The cool thing about this, or the interesting thing about this, is we use short-term rental projected income to get this thing approved again. Now, in a resort area where you have a lot of short-term rentals, that's very easy. Where it becomes a little bit of a challenge is like you're buying a property like this one in Georgetown, Texas, where there's not a ton of short-term rentals. It's not a resort area, but we needed to be able to use short-term rental to make this thing work. So the lender that I worked with was able to pull a short-term rental projection, and they used that regardless of what the appraiser comes up with. And the big issue or big difference there is that a lot of lenders that say they'll do short-term rental, they lean on the appraisers to get that number. And that's fine. Again, if it's in a resort area where there's a lot of short-term rentals, they can, do a little extra work and find it. But the challenge I see with it most of the time is, one, appraisers are lazy. The data's not available. And then they don't really make much of an effort to do it. So again, a lender that gives us that projection up front, we know where our debt service is before we even get an appraisal, and it's really helpful. So in this case, it worked because the long-term rent wouldn't have worked on that. So secret number 2, you don't need 700 credit score to get approved. We've talked a little bit about that, but the other part of non-QM loans are, credit situations, previous credit situations that you may have had that would require you to wait, 7 years for a bankruptcy, or, several years, 3-4 years for a foreclosure. Non-QM does have some options for that. There are some non-Q options that'll literally fund a loan one day out of foreclosure. Now, you have to still have a credit score that's decent, and you got to have assets and whatnot. But if there are some scenarios like that where somebody, hey, I just had a foreclosure, there was a storage situation. With COVID, we had situations where tenants weren't paying rent, and people couldn't afford it, and they ended up having foreclosures. There's storage situations that make sense. People had to move across the country because of that. Now all of a sudden, hey, I'm tired of renting, I need to buy a house, but I had a foreclosure. Yes, there are options for you. Again, we have to, kind of fit within the mold, but we can do it. So we can look at common sense underwriting in some of these scenarios and try and find a home for you. Again, you thought you had to wait 7 years for a bankruptcy. That's not always the case. We can get people in after bankruptcies within 6 to 12 months with foreclosures, sometimes even sooner. Here's another example of a non-QM loan that we just closed. Actually, this one closed in March of this year. The complexity of this one was that I had a borrower with his hands in 24 different companies, and his business bank statements were a complete nightmare because they had just money coming in from all over the place with different bank accounts, and trying to analyze the income from the main holding company that was getting all this, just nobody wanted to look at it. Everybody looked at the bank statements and said, there's no income here. He's just moving money around. And that wasn't really the case. So we had an income situation with the multiple businesses on a business account. We had to pivot to a personal account, which made it a little bit easier. And then we just had to look at a handful of companies and document all that. We also had a condo. This happens to be a standalone condo. And we had a lower credit score, and my borrower needed a 90% LTV. So he was trying to buy this house with 10% down. He didn't have the cash to put 15 or 20 was the main thing. We had 12 months reserves, but we just didn't have the additional money because it wasn't 100% liquid, and he didn't want to go into his retirement. So I had a challenge there. And the main thing was, or one of the main things was, that out of the 15 to 20 lenders I talked to, most of them wanted to do an 85% because of the condo. And then the others that I found that would even consider it at 90 looked at the bank statements and were like, yeah, this isn't going to work. So we narrowed it down to a 2. We jumped a bunch of hurdles to get this thing done, and we ended up closing it, and he was super happy. But again, it was just one of those complex things that ultimately took me talking to 15 plus different banks to figure out how to get it done for them. So that's really, the main thing to understand about these loans is there are no set guidelines, right? It's not like Fannie Freddie that has guideline and they're all the same. So anybody who's doing a conventional loan or a Fannie or Freddie loan, they're all the same. The only difference between lenders there is you have overlays. So, a Wells Fargo may want a 640 instead of a 620, or, they may want ratios to be at a certain level, or they may not do certain things. But for the most part, everybody's buying the same paper. In the non-QM space, every lender is selling to a different investor on the back end, and they all have their own products and their own niches, basically, where they like to, different areas that they're strong in. So you really have to know what your borrower profile is and then match it up with the lender. Number 3, rates aren't everything. All I'll say about that, literally, in essence, is that if you have a unique situation like this, any of these that I've shared, you're self-employed, you've got multiple properties, you've got business losses, you have, those complexities that come into play. The first thing about out of the mouth shouldn't be rate. It really is more important to find somebody that has knowledge and experience working outside of the box, because somebody quoting you a low rate means absolutely nothing if they can't close your loan. So most non-QM clients, are not necessarily rate shoppers. They're looking for solutions, and they're looking for ways to get into a home. A lot of these folks, you may be some of you on here. You've got money, you got a good job, you have credit. I just having a challenge. I have paper losses on my tax returns, or I have less than the requirements for whatever. But again, it's not about rate. The bottom line is, um, it's missed opportunity. And I always say you want to take into account the opportunity cost of not doing something. So, if you're waiting for that situation to get repaired, like, oh, okay, I need my tax returns to show income before I can buy a house, and that's going to take me 2 years. You've just lost out on 2 years of equity and appreciation, and potentially having a house. And so you got to take that into account. If there are options for you, even if it is a little bit higher rate, a lot of times it makes sense. And again, cash flow is great if you're an investor. But you know what? Equity is where you make most of your money in the investment world. So even if the rate's a little bit higher on the program you're looking at, and in my opinion, I always tell investors, well, are you paying the interest when you got a tenant in there? You understand you want the best cash flow and you want the lowest rate because it benefits you. But at the end of the day, if your 7% rate is being paid by your tenant and you're break even, but you're getting the equity, then in some cases it makes sense, and then you can always refinance later, potentially get into a better scenario. So again, the misconception, I'm going to wait till rates drop. The main thing I want you to understand about rates is the effect that it has on the property values, right? So it's estimated right now that a 1% rate drop or drop in interest rates will bring about 5 million buyers to the market. Right now, we only have about 1 million properties on the market nationwide. So what do you think is going to happen if 5 million people enter the market all at once when rates come down to five? So the number in the polling is everyone says, oh, if rates come down to five, then I'm in. So if rates come down to five, which, that's a pretty decent drop since we're pushing sevens again now. But if that happens, the property values or the cost of homes are going to go up significantly because there's going to be a rush on people buying, and that's going to cause pricing to go up. So again, you got to think about those things. Like right now, especially in my market in Austin, I don't know where everyone's from. There are some deals. It's a buyer's market. You can get sellers to pay closing costs. You can get them to come off of prices. I'm seeing significant price drops right now. I mean, we just saw one come down $40,000 a couple of weeks ago. So there are some opportunities to buy, which in my opinion are better than a little bit lower interest rate at a much higher price. So it's just, you gotta look at both sides of that. So again, here's a situation on a property that we closed a year and a half ago, I think. And the interest rates weren't the best right then, but they felt like this was a property that was going to be a good investment long term. So they were able or willing to forego kind of a little bit higher interest rate. We put them in a non-QM loan utilizing kind of a combined income with assets and a W-2, because there was two partners. They purchased this property, put it in the short-term rental pool. This is down in Port Aransas, Texas. And within 12 months, or I'm sorry, 18 months now, they've got over $100,000 in equity. So again, if they waited for rates to come down, they would have missed the opportunity. And 18 months later, they've got over $100,000 in equity. And guess what? We're now going to refinance that property. I'm going to get them into a little bit better term. And we're engaged in it now. We're probably going to wait just a little bit to see what happens, since rates went up just a little bit here in the last couple of weeks. But we got it close. And we'll be able to get them into a better deal that'll help their cash flow. So again, recap: you don't need W-2s or pay stubs. You don't need perfect credit. You don't need to chase low rates to get approved. There's options out there for you. It's just a matter of, looking kind of outside of the box. So let's take a quick break there and just ask. So now that you know it's possible, you're probably wondering, what's my next step? That's exactly what I'm here to help you with. So my question is how do you feel now? Was this good information? Did you learn some stuff about loans maybe that you didn't know? If you could put in the chat for me real quick, I'd appreciate it. Anybody learn anything tonight? Anybody excited about maybe talking a little bit more about some of these products? All right. Thanks, Samantha. I appreciate that. Nakia, thank you very much. All right. So really, what's your next step? So we're at a point now where, you can either take action or you can not take action. Those that take action usually, reap the rewards. So I just like to say, listen, it doesn't hurt you to take the next step and talk, right? There's no commitment here. We just want to kind of chat. So I would love to chat with each and every one of you. You're on this webinar for a reason. You obviously have some interest. Maybe you've had some challenges, whether you're trying to buy a primary residence or an investment property, we've got solutions. So the next step would be, hey, let's book that's weird. Red spot there. Let's book a 30-minute call and just talk about your profile. And then we can talk specifically more about, hey, let's review your income profile. How do any of these products work for you? Are there any of them that actually fit into that? What are the specific requirements for those type of programs? Let's put together a personalized game plan. Are you looking to add real estate to your portfolio, your investment portfolio? Are you trying to get into, your own primary residence? There's a lot of different scenarios and there's a lot of different challenges. We just have to kind of have a plan together. But the bottom line is if you come to me and we put a plan together, I promise I'll be there to hold your hand the whole way. And at some point down the road, we'll get you in that home. And then I can connect you with the real estate community as well. If you don't have a realtor, we do have a program for what I call my Partner Plus Realtor program. If you use us, we do have some benefits for that as well. So again, I'd love to chat with you. I'd love for you to book a quick call with me and we can go through that. There's a QR code right here. I'm going to drop all three of these into the chat because I didn't do it earlier, but let's see. All right, I'm going to drop these links into chat for you. And the first one is if you would like to book a call, I would love to chat with you one-on-one and answer any specific questions you have. The second one is for the Homebuyer Academy Facebook group. If you want a copy of the book or you'd like to join my group, I would love to have you. I'd love to be able to keep in touch and share more valuable information with you online. And the third one is for the investment property group, strategic investments on Facebook as well. So if you're on there, either one of those, if you have any interest. Okay. Quick plug for Griffin Financial. If you come and talk to me, we're going to talk specifically about mortgages. How do we get you into a home? How do we get you into an investment property? What's the best scenario? I've got tons of knowledge on the investment side as well as primary residence, but to get you in a home, these guys are great about protecting your assets. So I just throw it out there. If you want a game plan on a larger level of how do I now protect these assets? How do I set up my retirement? How do I protect everything from my family in regards to wills, trusts, or anything like that? Mortgage protection. Great group. If you want information on that, just text me later or email me. I'm more than happy to share more information. They're great people. I've worked with them for years. So again, I want to just say thank you for showing up. We had a fairly small group, couple of latecomers. I'm here to answer any quick questions, I guess, in general, but would love to chat with you more one-on-one. So I'll open it up if there's any questions in the chat. Does anybody have any specific questions on anything that we discussed tonight?
Hi, my name is Zakia. I would like to, I don't see the link. I don't see the link that you sent out, the 3 links, because I would like to book a one-on-one call with
Here we
you.
go. Hang on. Oh, it says to everyone. It's in the chat. You don't see it in the chat? Oh, there it is. There it is. Sorry, I didn't hit. I copied it, but I didn't hit enter. There you go.
Okay, I have it now. Thank you.
Yep. Anybody else got any questions? Anything specific we can talk about real quick? feel free to unmute or put it in the chat either way. If not, then I will call it a night and hope to talk with you. But please, I would love for you to jump on Facebook and join the group. That's a great way for us to stay in touch and share information. Would really appreciate it. I'm trying to grow that Homebuyer Academy group a little bit. It's fairly new. The strategic investment's been out there for some time. But I would greatly appreciate it. I'd be very grateful if you jumped on. All right, doesn't sound like we got any other questions.
I do have one question. Are you a broker by chance? Because I'm about to take my real estate test in about 2 weeks, and I haven't found a broker yet, and I'm in Texas.
Where are you at?
I'm in Dallas, Texas, north of Dallas, but I might be,
Dallas.
yeah, I might relocate to Houston. It just all depends.
Okay. Yeah, I'm actually in Austin. And I am a broker. I work for Nexa Mortgage, which is one of the largest brokers in the country right now, but we have access to over 200 different lenders. So that's really the big thing about being a broker, is just really having all the products. And we've just got a lot of different banks and kind of a lot of the outside of the box non-QM commercial stuff that we've got access to.
Oh, okay. Yeah, I'm into real estate. I'm just ready to get the ball rolling with it.
Well, good for you. I wish you the best. But if you get licensed and you have questions on any of that, I also run another webinar for first-time buyers, and we talk a lot about down payment assistance. So just keep my contact, and if you get licensed, I'd be more than happy to chat with you and see if we can't, work together to market some stuff like that.
Okay, sounds good. Will do. Thank you.
All right, you're welcome.
Hey Matt, how are you this evening? This is Nakia. How you doing?
I'm good. How are you?
Good. So I actually saw you in the group. I think it's the group that you just mentioned. I think I've been in it for like a week or so now, and it's actually a really great group because I'm getting ready to sit for my MLO license in about 2 weeks. And my daughter's graduating from high school next year, and we're looking to move to Houston. And I'll actually be there in about 2 months too. Just to hang out and stuff like that, go to the Beyonce concert. Um, but I just wanted to know, like, do you do like different types of webinars, like for MLOs and for like how to purchase? Because when I move to Texas next year, I'm currently renting in Virginia, but I do want to purchase a home in Texas. Like I've been looking, like kind of weighing my options and stuff like that. So I'll actually need an MLO anyways. And then I wanted to know if like, do you like do any type of mentorship programs and stuff like that? For newcomers?
So we do have a training program within Nexa. Yeah, it's called Nexa University. So somebody that's brand new would be required to go through that. Unless you got somebody as a branch to sponsor you, but there are some options. We could definitely chat about that. So you're getting your license right now?
Yeah, so I actually took the class like 2 years ago. I took a real estate class as well, but I figured I'd be better at mortgages. I don't know. I used to be a processor years ago, like when I first, like it was one of my first corporate jobs, probably like 20 years ago, before the license was ever required. So I'm not brand spanking new to it, but with all these laws and everything that they have now with the SAFE Act and all that, that's what I'm learning. But as far as like the pulling the credit and all that stuff, like I've seen loan files before. So I'm not like super brand new to it. And I do know somewhat about the different products and stuff because my plan was to broker loans for like, investment loans and stuff like that and residential. And some SBA, a little bit of I used to be like a referral agent for a company out of New York. So I'm not like super new to the industry, but I don't have the MLO license yet. But once I get it, I plan to be licensed in Virginia and Texas because I want to move to Texas next year. So just looking into some options of like people who maybe offer, those types of programs and stuff.
Okay. Yeah, we could talk about that if you want to reach out to me on a one-on-one or maybe email. There's some
Yeah.
different
And definitely
options just
for
depending on.
purchasing next year too. Like because when I come, I don't want to rent. I would love to be able to purchase a home.
Now,
The
have you considered buying out here before you move?
Yeah, so that's possibly my plan, but I was just like, I just didn't want. I guess I want to take one step at a time because with me getting ready to get an MLO license, that'll actually be considered like a new career for me.
Right.
So I have to figure out like, am I going to use my old career or if I'm going to use the new one? Now, the new one would get me the house that I want, of course, probably, but I'm okay with, just buying a home that I can afford right now and then, maybe using it as a rental property later or something.
Well, I
Um,
think the question I would have is because you're starting a new career, like you said, you're going to have that 2-year window.
mhm.
Well, because in most cases now you can go work for a bank that may pay you a salary and be a W-2, but if you're going to be like an independent broker like I am, you're in
Mhm.
essence self-employed. And then you've got that 2-year history to qualify for most products. There are some non-QM like we talked about tonight that are, pushing the envelope at 12 months, but you got to have income the first 12 months. And the big thing in the mortgage business is just the business, right? If you're in 100% sales, you've got to generate the business.
Right.
But anyway, so that's why I say a lot of times it makes more sense if you're an employee now and you've got family. I don't know what the situation is, but maybe you buy now, even if it's as an investment property where you have the benefit of getting or utilizing the rent income on the property to buy it. And then you move into it when you get here, then you've got a house. You don't have to worry about
Oh,
qualifying.
you
And then
can do that.
you establish your business. And then, like you said, maybe you turn that into a rental and buy the house of your dreams later. But yeah, I mean, that's a lot of times hear people that, oh, I relocated and I want to buy, but hey, I don't have that 2 years. Well, if you'd have bought, 3 months ago before you quit your job or relocated because now you have a totally new job, we might have been able to qualify you then. So it's
Got
something to consider.
Gotcha. So I should so what I actually do is I can actually do it while I do my MLO stuff as well. So it's a career that I can do at the same time. But that makes a lot, that helps me because I didn't even think about that, and I was just I mean, of course I was going to purchase a home before I got there, but it does make sense to purchase it with the income that I have now, and then later down the line we can move some stuff around. Okay.
Yeah,
Awesome.
because even if you've got so this comes up a lot with people that, especially with COVID, everybody started working from home. But a lot of people go, "Oh, I work from home, so I can move and I can technically work anywhere." But the employer has to acknowledge the move because what happens is when we verify the employment, part of that verification is, does this move to a different state have any negative impact on their income, right? So
Hmm.
there's different costs of living. The cost of living in New York is significantly different than it is in Texas. So they want to know, okay, is your income going to be adjusted based on where you live, or how is this negatively going to affect you? You're in a totally different market. Is your market going to change, or you and is your territory the same and you can work from wherever? So that the employer has to acknowledge that. And so it's, you know, if I don't know if that's a situation now with your case, but I
No,
mean,
so like
if you
I
haven't
do.
moved, then you still have that.
Yeah, got you. Okay. That definitely is helpful because I didn't even think to, just use the salary that I have now and then, move the stuff around later. So that
Yeah,
helps.
absolutely.
And I'm still learning.
Absolutely.
So I'm still learning. I'm actually going home to study right now. So uh,
Well, good luck. Good luck.
so
There's a lot
thank
to
you.
learn, but it's
It is.
there's just so many products out there, especially
Yeah.
now with the non-QM stuff. So,
Yeah.
all
Yeah.
right. Well, thanks for
Thank you.
joining. It was nice chatting with you.
Thank you.
All right. We got one more. You're the last one. You got any questions? Zakia, is it Zakia or Zakaya? Sorry if I'm butchering your name, but
Oh, I had spoke earlier. I was just listening to the conversation just in case I could take away anything from it. But I
all
just
right.
scheduled my 101 with you. I'll have more questions then.
Okay, perfect, perfect. Well, I appreciate you spending a little time with me tonight, and we'll talk to you here soon.
All right, thank you. You have a good
Good
evening.
night.
All right, you too. Take
Bye
care.
bye.
Bye.